Hey, Robert.
Hey, Yaron.
Interesting times, huh? So,
Well, the whole crypto world changed in the last few days after a period of relative stability.
well, in a period, yeah, relative stability in a period in which it seemed like there was like one dominant player, and they were kind of calming everybody down, and they were buying a lot of the problem assets in the crypto space, and then shockingly, they're the ones who fail.
I don't know if it's that shocking.
I mean, the market responded in a shocking way. I mean, and the hype. There was a lot of hype around. I forget his name. It's three
SBF.
Yeah. So there's a lot of hype around him and about FTX and its success so far. Like there was a lot of hype about everything in crypto, but it all went away in a flash. That's what's so amazing.
Well, that's finance for you, right?
Yeah, yeah.
I think FTX was viewed as unique because they had the strongest link to Silicon Valley. They had big name investors. They had SoftBank, they had Sequoia.
Sequoia, yeah.
They got, I think it was close to $1 billion, maybe $900 million at a $30 billion valuation not too long ago. So they had a war chest. It just, in finance, you can burn through an extraordinary amount of money very quickly when the tide turns against you and people lose confidence.
So I mean, that's true in because of this mismatch between the your liabilities and your assets. So maybe let's walk through this, and maybe start with just an example from banks, because in a sense this is so. Why do we see or saw before the FDIC insurance? Why do we see bank runs?
Well, even before that, I think we need to distinguish between a broker and what you might generally call a dealer.
Yep.
A lot like Coinbase, for example, I think is primarily a broker. Robinhood is a broker. Schwab is a broker. These are entities that facilitate trade, and they're not in the business of holding assets on their balance sheet. That doesn't mean they don't have assets on their balance
Yep.
sheet. It means that that's not their business. A dealer holds assets, holds inventory.
So as a broker, there's very little risk, right? Because they're not holding anything. They're just facilitating other people's transactions. It's almost like selling the pick and shovel to the miners in the gold rush, not actually going and mining and taking the risk involved in the mining.
It definitely has that element. You think about like a real estate broker. If a house sale falls through because prices collapse, they don't lose a lot. They lose their commission. It's not good for them. It's bad for their business, but they don't lose a bunch of money on the asset. Versus when Zillow got into buying houses using their algorithm and then holding them in inventory and flipping them, they made a lot of money when prices went up, and they lost a lot of money when prices turned. So it's much riskier to be a dealer because you have a balance sheet, and once you have a balance sheet, then it's a question of how do you finance the balance sheet. So banks are dealers, broadly speaking. They hold the money, they take deposits, and then they make loans in the simplest case. And unfortunately for banks, what people want as deposits and what people want as loans are very different. People want deposits that are very accessible, so very short term, very liquid. Basically, give me my money back whenever I want it. Borrowers don't want the same thing from their lenders. They want money that is stable, that is locked up for a long time. We don't have to pay it back for 10 years. So essentially, you're taking people's money when they want to be able to take out immediately, and in the extreme, making loans like a 30-year mortgage.
So how does a crypto exchange like FTX work as a dealer, in a sense? In what ways does it parallel banks?
It only shifts. So FTX is an exchange. It's by default a broker. The New York Stock Exchange doesn't hold a bunch of inventory of the stocks that trade on it,
Yep.
but the specialists on the New York Stock Exchange do. So there's generally an element of market making or liquidity providing within an exchange. And we don't really know with FTX because crypto is so freaking opaque. But one of the big providers was SBF's trading firm, so Alameda Research, and exactly how it works is unclear. You start doing one, you end up doing both things. You introduce the kind of risk that dealers have. One is if you provide leverage. So yes, Schwab is a broker, but when they lend their customers money, then they start to become more like a dealer because they are holding some of the exposure to the underlying assets. So they might only lend 50 cents on the dollar, but with a cryptocurrency, its price falling by 50% is not outrageous. So some of the losses can flow through to what was before a broker and now is more at risk. And the second is when you do derivatives trading. Derivatives inherently involve leverage, and they also inherently involve counterparty risk, as do loans. I mean, that's always a problem. If I give you my money as a deposit and you lend it out and the loan doesn't get paid back, I don't get paid. My deposit is gone unless you have some other way to cover it. And so that's counterparty risk. It's where the people who are using the money, if they run into trouble, then the people who provided the money, the problems flow through to them.
Now, part of the issues here is that these exchanges issue coins. So FTX issued a coin, and it turned out that most of Alameda's collateral, in a sense, was the coin to FTX, was a coin issued by FTX, which is more complex than I can really handle. But so what's going on here with the coins? To what extent did the difficulties, which we've talked about before with stable coins, play a role here with FTX?
Well, the FTT coin was not a stable coin. It was more of an equity coin in the sense that you got discounts, you got a piece of the action in terms of the trading on FTX. So in a real sense, that coin it exists. It's just created. I was gonna say it's issued, but really that's the crazy thing is all this stuff is just created out of nothing. Now that's not totally crazy. Don't get me wrong, because Facebook was basically created out of nothing. Google was created out of nothing. These things, it's not an immediate knock, but it does mean that it can go to zero very quickly. In the same way that Google and Facebook didn't go to zero, but lots of startups they're created and then they just disappear. But when you've got trillions of dollars of financial transactions being based on something that can just disappear, it's really volatile. It can get ugly very fast. So the coins that are being created are essentially crypto itself. There's a lot of talk about how we don't want there to be any leverage in crypto because fractional reserve banking is at the root of all evils. So crypto is not going to do that. But crypto is inherently similar to fractional reserve banking or any leveraged asset. It's just the leverage in this case is a leverage of belief. It's
ultimate leverage.
It is, in a sense, the ultimate leverage, and it's everywhere. It's not unique to crypto. If people stop believing that Google is worth something, then we're seeing this in Twitter a little bit. Advertisers start to leave, and it becomes a self-fulfilling prophecy.
In a sense, there's a hook to reality in the sense that Google has earnings and it has assets and it has something that grounds the belief in a particular value, but that belief changes over time with changing circumstances. Crypto seems less anchored to reality in the way that, because it isn't connected necessarily to a particular asset, although here FTT was linked to FTX, right? So as long as the exchange is doing well, supposedly, FTT should be doing well.
Yeah, the business model in crypto seems to be helping people trade crypto. And that's a dangerous business model. It's very self-referential, just like the coins being the collateral. But that doesn't mean it can't work. It just means that it's dangerous. It would be as if Silicon Valley paid all their employees in stock, which in fact they do to some extent. This is not unique to crypto, but crypto has taken it to an extreme. And yes, Google is anchored in reality, and any impact would have to flow through reality. It would have to flow through advertisers and searchers and all the things that actually create value in the Google platform. But with crypto, it's all in one little pot, the crypto pot.
Yeah.
So I don't, I'm not gonna, we're not gonna be able to explain this
Yeah.
because it's too opaque, but the communication is that it's not surprising
Yeah.
because a lot of crypto is traded as derivatives.
Yep.
And a lot, there is inherent, I mean, we saw this in the spring with first starting with Terra Luna and then with Celsius, that there is leverage embedded in the crypto ecosystem. And there's no transparency, so nobody has a good sense of how much there is. And so anytime one of these events happens, then Tether goes down because Tether is totally opaque and nobody knows whether they have 99 cents on the dollar or $1.01 in terms of assets backing the stable coin. And so we can expect this to continue. I saw a proposal by, is it CZ who runs Binance?
Yeah, I think it's CZ. Yeah.
It's hard to keep track of all the initials, but that exchanges need to start being forthright. Fractional banking is a thing that doesn't belong in crypto, and they're going to start allowing customers to be able to see that their assets are, that's all nonsense. That's total BS. Binance is trading trillions of dollars. The number I saw is $1.6 trillion of derivatives. There's risk there.
And it's just crypto. All they do is trade crypto.
And it's all crypto. Yeah. And if it was gold futures, it would be less volatile because gold is less volatile than Bitcoin, but it would still be wildly risky because futures are inherently levered. I assume that they are not requiring a dollar or a Bitcoin deposit for each Bitcoin future that you trade.
Binance is the largest, I guess, of all these exchanges, and it's, as of yesterday, it was bailing out FTX. It was going to take them over at some minimal cost, supposedly. As of this morning, rumor is that they're going to back out because things at FTX are much worse than they thought they were. But of course, this is a moving target right now, so we don't know. We're recording this on Wednesday around early afternoon on the East Coast. So things are changing very quickly on the Pacific Coast, in Silicon Valley, where this is all happening. So what can we learn from all this? I mean, is this reason to say, okay, the whole crypto phenomena, it's just a craze. It's not like the dot-com bubble, because nothing good will come of it. At least dot-coms, a lot of stuff collapsed, but some things survived. And overall, I think we were all better off for having the dot-com bubble. Is there a sense that something will survive once all the pain is had on the crypto space? Is there Is there something real?
Too early to tell. It's as if we were asking in early 2000 whether anything good was going to come out of the dot-com boom that was now turning into a bust. Certainly nobody thought Amazon was going to be what it is today.
But you had a sense that online shopping was going to be something. So it was more, who were the winners and losers, you didn't know, but you knew this was the future.
Dial it back, because Webvan had wasted $1 billion doing grocery delivery, which now is a thing. And I remember us talking about it at the time, because we at the time shared an office and would get together. We would talk a lot about Webvan because we thought if I remember right, we thought Webvan was ridiculous, but the whole way they were doing delivery, it wasn't even optimized. It was just whoever happened to be on the route. There was a lot, and they were building warehouses before they had. So it was, but we knew that there was something there. We all knew that this was the direction it would ultimately go. Okay, so it's easy to say that now, because it did, and I agree with you that we weren't writing off. We were all using the internet. The fact is, people are not all using crypto, but everyone was using the internet at that point. So I'm not saying it's the same. I am saying, though, that it was too early to tell then, and it's too early to tell now, because a lot of stuff that looks like it can't work, it might end up working. And I'll point to Amazon as that. But look, if you went back to how people were making money in 1999, a lot of the successful websites were making money by
Oh, yeah.
investing in other startups,
Yeah.
internet startups that would hopefully go crazy and they'd
Yep.
make a lot of money, or
Yep.
selling them advertising or selling them leads. It
Yep.
was very self-referential.
It was.
And so you knew that most of it was going to crash and burn, because
Yeah.
once VCs stopped pouring money into internet startups, who is going to be buying all of those servers? Who's going to be buying all of the things that look like the real companies? Now
Yeah.
they ended up being real companies, but they took a massive hit. I mean, Cisco went down 80% from it. Its stock price went down 80% from its peak.
So, so what's interesting now, I think, is okay. So these business models are now working for a variety of reasons. So crypto's still looking for its application for how to kind of, the experimentation is ongoing. What's going to be interesting is kind of the next phase where somebody gets it right, and we get to see the Amazon of crypto, or the if that even happens, it might turn out that the whole thing's a sham.
It could all be Laserdisc, where everyone gets excited about it, and now no one knows what I'm talking about.
Yeah.
But I think that you're absolutely right, and that it's going to come out of this downturn. You have to have the easy money disappear. You have to have the flawed business models stop working. And if you can become a billionaire with a flawed business model, a lot of people are going to do that, and they're not going to look that hard for
Yeah.
something that would be longer term, more difficult. And get rich quick is very attractive.
Mhm.
And actually building something that hundreds of millions of people will use, is still to come. And it's not trading crypto. If
It's
people
not
are trading
trading. You have to
crypto,
do something with the crypto. Yes,
exactly. If
it has
people
to
are
serve a
trading
purpose.
crypto in 20 years, they're going to be trading it on Schwab.
Yeah.
They're not. It is that if that's the mainstream business model, then it'll be just like all of the niche financial service firms that were created in the late 90s. They're either going to be absorbed by, in the case of like iShares, ETFs, they'll be
Yep.
absorbed by the existing behemoths in finance, or they'll just disappear because there isn't enough gain for it. But then you're going to find other things. No one was talking about social networking in early 2000. Nobody was thinking about how well you could target advertising. Everyone's using Google for search, but
Yep.
Google
Not
ad
advertising.
space, AdWords were not a thing yet.
Yep.
The world ended up being very different from what people got excited about early, which was, places like Yahoo and Amazon, where you could go and do things very easily, very quick. But that isn't where the value ended up being.
Yep. So it's going to be interesting to watch how the space changes over the next few years, and how it continues to experiment. I don't think either one thinks necessarily this is the end of the bubble bursting. It's just one more step. Who knows where it goes from here? But we wouldn't be surprised if another, if the rest,
I
if
can't
it's a lot more.
believe that no one's thinking that Binance is going to have the same
Yep.
moment.
Yep.
Because it's basically the same business model. Now, I could be wrong, because nobody knows. We don't know what important differences there are.
So do you think there is a business model out there that makes sense?
Well, we've talked about this. The model that I think makes sense is leveraging crypto to empower entrepreneurial efforts. Somehow being able to organize people around the world in a self-organizing way,
Mhm.
which
Yeah.
is hard to wrap your brain about. The closest I can think of as an example is Werner Vinge has a book called Rainbow's End, and it's a science fiction story, but it's in the near future.
Mhm.
And one of the characters is it isn't said, but it's pretty clear that they're an autonomous AI that lives in the network and is managing a sort of the strategy behind a lot of what's happening in the story. But what's really interesting about the book is there are ways that people can self-organize projects. And so somebody is behind it, and then everyone has an accountability, a commitment to what they're going to do, and they're compensated for that. And we never really get into how is the actual finance, the story doesn't get into it. How's the finance behind that?
Yeah.
But cryptocurrency would be a perfect way to do that. And you could have project specific coins. You could have, that were intended to last for a long time or only intended to last for a short time for the life of the
Yeah.
project. And then everyone, it's automatically cashed out. And all this could be done in a very automated, very transparent, very safe and robust way using the technology behind crypto. But unless you're allowing something to happen in the world that creates value that wasn't happening before,
Yeah.
It's really hard to look at it. And crypto has it even worse because they have to deal with all of the challenges of finance.
Yeah.
And the big thing being that you get these sort of liquidity runs. I don't know if FTX was insolvent, because it's hard to say when you have illiquid assets what they're really worth.
Yeah.
But if you have to liquidate them quickly, then suddenly the value goes way down. And the finance sector has been dealing with this for probably thousands of years, but certainly hundreds of years.
Yep.
And we saw it big in 2008, and we saw, Bear Stearns get bought for $2 a share by JP Morgan, which, was a fraction, like 10 cents on the dollar of their book value, much less their market value 2 weeks earlier. We saw Lehman go to zero. This is what you have to deal with in finance, and it's not fun to deal with. It's much, and it only shows up when in a downturn.
The real challenge, I guess, for crypto is when does it stop being just isn't the right word, but when does it stop being just a financial asset really and become, connected to reality in that way, the operating system behind something, the thing that facilitates some real activity rather than just trading.
And then you'll be less susceptible to runs, because right now, since FTT can go to zero at any moment, people are very skeptical once there are problems. And everything's going well, it looks rock solid, but it really is built on sand until you get that core underlying value. Like, where you objected when I raised Google as an example, because it's fundamentally different. There's hundreds of millions of dollars of revenue and tens of billions of dollars in profit being generated by the business model. Yeah, that is different than all the profit comes from people trading in a zero-sum game with each other basically, if crypto ends up being a massive casino, that's not bad. I don't do a lot of gambling, and so I'm not going to be,
it has entertainment value.
But there are people who, and it's a global business. It's huge, but it's very different than actually creating new financial systems or creating new ways to fund interesting projects.
Yeah. So the real issue is value creation. Crypto's not yet found the way in which it actually creates value beyond maybe the entertainment and the chasing the billionaire value.
Which is something. A lot of people bought tickets for the $2 billion Powerball. But you're exactly right, because it's fundamentally different. Gambling is a zero, so it's actually negative sum because someone's, the house is getting its cut. And that's fine for entertainment, but entertainment is the result of productivity. We are able to consume entertainment because we're productive in other areas. And so I think that as we move forward in crypto, we'll know that things are about to explode when people are talking about where they're really creating value. Not we're creating an ecosystem, we're creating a platform. I was telling you the other day that it reminds me more and more of Ponzi's being sold in a multi-level marketing framework, because your goal is to get other people to believe, and then to get them committed to and incentivized to have more people believe, so that you can all get out before it all blows up. And that's not even gambling. That's something else.
Yep. Good. Well, we'll see what happens next week.
Well, we'll definitely have to be touching on this on a weekly basis, because things are moving fast.
Good. Well, thanks, Robert.
Thanks,
Talk to you next week. Bye.
Bye-bye.